Welcome to the Personal Pension Radio Podcast, where you get unconventional insights into wealth building and retirement that actually work. Discover data-driven strategies and learn from a wealth of experience so that you can take your retirement to the next level. Now, here's your host. He was once bitten by a harbor seal, the income engineer, Kraig Strom.
Okay, we are back on Personal Pension Radio. Good to have you back. Thank you for listening, and thank you wherever you might be. We have just had a wonderful last year or so as we started this podcast in 2015, and we have listeners all around the globe, largely in the United States, of course, but thank you to all of our listeners in Canada, listeners all the way to the Philippines. We've got listeners from east to west in the U.S., and we're glad to have you. We are broadcasting today from Mr. Foley's van, parked in front of Saline Automotive in Corona, California. If you don't know who Steve Saline is and the Saline Automotive Group, they build some really hot rod, fancy cars, and it happens to be the location of my weekly car show. I actually started a car show last year with the help of some folks here in the city that I live in. The area was in Corona. And with the folks at Saline Automotive, we actually kicked off a car show last year, and it's been a great way for me to scratch the love of cars itch, if you will, without spending a ton of money on cars. So I tell people what happens is people bring me 80 to 120 cars every weekend for my collection, and then they take them home and park them in their various garages. So I get to enjoy them on the weekend, and I don't have to pay for the insurance or the gas or the repairs on any of them. So it's nice to have my car collection come in every Saturday and head back out. There'll be notes for the show will always be on the website at Personal Pension Radio. If you'd like to see some pictures from the car show, I'll put a link in there to Cars and Coffee Corona. There'll be a link in there to the Facebook page, so you can check that out. So, as I mentioned, brought to you by Personal Pension Radio. What is the show all about? If you've never been to this, found the show, or you've stumbled across it here, Personal Pension Radio is all about the retirement income question. And in the world of financial advisors, the world that I live in for the last 18 plus years, the retirement income conversation has been very minimal. I have to tell you, just from personal experience, very little education was ever sent my way in regards to retirement income planning. And stop and think about it. Isn't that really why we're saving money? The entire financial world is all about save, and saving money, and that's all well and good. But what's the ultimate goal? What's the ultimate end game? It's to have an income someday to replace the income you had when you were working, right? So there was very little information for me coming up in the business, and I've had people ask me this question many times, and even recently folks had asked me this question: why is that? They asked, Kraig, why isn't there more information out there about retirement income planning and the risks associated with retirement income? My answer has always been to ask a question. So think about this for a second. Does the financial community, the investment community, the Wall Street machine, do they have any financial incentive to teach you how to take your money out of the system? Distributions, right? Income and distributions is generally taking money out of that financial system. Do they really have any incentive to spend money to teach you how to do that? Well, I would argue no. And I'm not saying at all that that's insidious or somehow evil or something negative. Not at all. That's just good business. I mean, it doesn't behoove the financial and investment community in general to teach and spend money teaching people how to take money out of their machine. So what I found years ago is I found a real void, a real gap in financial advisory communities in the area of income planning and that specialty of being able to help people put together both their savings and the distribution component of their retirement plan. Because the world primarily focuses on the savings aspect of retirement, that the answer to retirement income and having more income is just to save more. I want more income in retirement. I'd like to travel more in retirement. Oh, you need to save more. Well, I would like to take my children on special events, or I'd like to be able to help my kids with college. You need to save more, right? You get it. It didn't matter what you were wanting. The answer is save more. Well, that's true. You do need to save for retirement and build assets, but unless you have a balanced approach between your mutual fund assets, life insurance assets, real estate, annuities, investments in general, if you do not have a balanced approach, none of those financial vehicles by themselves will help you optimize your retirement income. You have to have an integrated approach where those things are weaved together properly. Okay, so that's what Personal Pension Radio is all about, is the conversation around retirement income. And I blend in a variety of different pieces of this conversation that you may not hear all of it in one place in this podcast, but if you are inspired by something you hear, remember, don't act on the advice. Don't act on the advice unless you have sat down or pulled up a phone call or done a go-to meeting, a web meeting with a qualified financial advisor. I would be happy to talk to you wherever you might be. Go to the website, Personal Pension Radio, and ask me a question. Ask me for an appointment. We'll have a phone call. We'll say hello. But please don't act on the advice that you hear on the radio or read in a magazine or hear from a financial entertainer, because in order to make sure that you're getting comprehensive, really good advice, you've got to sit down and go over your specific situation. You've got to do that. So my little disclosure there before I get started. The first segment I want to go through is I want to talk about watching your step is the segment that I start with. So watch yourself on this one, because it's all over the place. And full disclosure, again, full disclosure, I'm going to give you my opinion on things as I go through this. I want you to go to the website here, check the show notes, ask questions, all right? I want you to ask questions. I don't want you just to take everything at this point for this is how it works for you, or this is what Kraig is recommending for you. So the first segment is watch your step. There's lots of information out there today on a concept, a system, a process, whatever you want to call it, called Bank on Yourself. It's also been called infinite banking. And this is, in a nutshell, a system or strategy that uses a certain type of life insurance that allows you to accumulate cash value and then borrow from the insurance company for loans that you can finance investments and things like that. And my issue with Bank on Yourself, because I am a big believer in it, but not for the reasons that are primarily taught by those who really push it hard. I believe in infinite banking and Bank on Yourself because of the concepts underneath it. And I'm going to go into that in a moment here, but let me make sure that I've given it justice as far as what it's all about. Bank on Yourself and infinite banking are concepts that use life insurance. Now, there are a lot of financial professionals out there that have taken this general idea of saying bank on yourself or infinite banking, then they've then taken and used it with just about any kind of cash value life insurance you can think of. All kinds of different cash value life insurance exists out there. But in my opinion, there's only really one particular kind of cash value life insurance and one specific way that that insurance should be used and designed if it's going to work with this infinite banking or bank on yourself concept. Okay? So be careful with that. If you are having conversations with someone, or you've heard about it or read about it, this idea of having your own personal bank, it's a very sound concept when you come at it from the right perspective, with the right designs, with the right types of policies, and you understand truly the concepts behind it and the math that makes it work, and how to properly deploy the strategy. That's a key word there, how to deploy the strategy and not just use it for, gosh, I have heard financial advisors, this is no joke, I have heard financial advisors pitching Bank on Yourself and infinite banking and taking loans from life insurance policies to pay for basic personal expenses. Right down to, I've actually heard financial advisors saying, oh yes, you could finance all of your household expenses, even your grocery bill. What? I was amazed. I mean, that's the kind of crazy stuff that I've heard out there, and I want you to be mindful of that. Really be careful. If you've had a conversation or you've thought about it, the bank on yourself concept, the infinite banking concept, those are both interchangeable terms. It is a sound concept if it is applied and deployed correctly. And here's what I want to caution you before I forget. I cannot tell you how many times I have heard people say that, oh, well, what you're doing is you're buying a life insurance policy and you're putting money in a life insurance policy and you build up some cash value, and then you can borrow your money and you can pay yourself back. Okay? That's what I've heard. That's exactly what people say, is they can borrow their money and then they're paying themselves back, and they're able to make X increase in their interest because they're paying themselves back. Well, that is absolutely wrong. Completely wrong. Okay? This is really, really important. The infinite banking concept works because you are never borrowing your own money. You are borrowing from the life insurance company, who is simply using your cash value in this life insurance account as collateral. So that's why it's so important to have the right kind of life insurance and to have the right design. Because if you have the right type and the right design, your asset stays inside that life insurance and continues to earn, let's say, dividends and interest and such. Okay, those things are not guaranteed, of course, but you're earning those things, let's say. And the insurance company still lets you borrow their money at interest while your money stays in your cash value account earning a rate of return. That's where the true power comes in, is you're not borrowing your own money, but you are borrowing money from a financial institution, namely a life insurance company. Okay, so it's so important to understand. Now, how you deploy that borrowed money, that loan, and how you pay it back, that has to be handled very carefully. It has to be seriously considered and analyzed. And the concept that makes it work, or the concept that really underlies the infinite banking or the bank on yourself concept, is the compound versus amortized concept. Okay, so I'll call it a concept. Compound versus amortized interest is the real magic, if you will, the math behind how it works. But here's the secret, or a secret, that the infinite banking and the bank on yourself community generally doesn't share, is that the life insurance companies are not the only place that you could access and use for this concept. So it's not exclusive to the life insurance community. It can be done in other ways. So what you need to have, I mean, there's three primary places that you can have this relationship, because what we're looking for, if you're going to set up an infinite banking concept, what you're looking for is the ability to hold assets in an account and be able to access loans from a financial institution without stopping the compounding of the underlying assets that the companies are using for collateral. So the three places that I tell people that you can access that kind of a loan: one, if you have a family member that likes you, you have to have a family member that loves you, and they will lend you money using perhaps your good faith and goodwill as collateral, so that, let's say that you're going to borrow $50,000. Well, you borrow $50,000 from Aunt Gladys, and your $50,000 stays inside your investment account, earning a rate of return. Because Aunt Gladys loves you, she charges you a reasonable interest rate, and you pay Aunt Gladys back. Now, you might take that $50,000 and use it to invest in real estate, okay? And hopefully you're making a good rate of return on that, and you want to make a better rate of return than, let's say, 5%. That's what Aunt Gladys is charging you. The nice part is that your $50,000 is still staying out there in your savings or investment account, earning its own rate of return, and you have this $50,000 of loan money that you can use to make an investment and earn an additional rate of return on Aunt Gladys's money. And then you pay Aunt Gladys back. Okay, so number one, you can get this kind of a loan from a family member if you have that type of a relationship. Number two, the second place that you can get this kind of a loan is if you have a substantial amount of money in an investment portfolio. So an investment portfolio would be something like mutual funds or assets under management, something like Fidelity, Charles Schwab. Some of these major brokerage firms offer this. Excuse me. Where if you have a significant amount of money, generally it has to be a significant amount of money, $500,000 or more, in an investment portfolio that is invested, the investment company will lend you money using your investment account as collateral against that loan, allowing your investment money to stay earning a rate of return. Now, most of the arrangements will let that investment account stay fully invested. Some investment companies require money to be held aside in safety as collateral. So if it has to be held aside in safety and collateral, and maybe it's not earning a very good rate of return, then why bother? But let's just say that we could have an account at an investment company that allows the money to stay invested, earning a rate of return, and we can still access the investment company's loan. So now we go and make our investment if we wanted to with that loan, buy real estate or invest in a business, and we make a nice rate of return, and we pay back the investment company. We're not paying ourselves back, we're paying back the investment company for the cost of that loan. And the third place, okay, so we had Aunt Gladys, then we had investment companies that offer collateralized investment accounts. Call it collateralized investment account. And then the third place is cash value life insurance. Now, there's a number of different types of cash value life insurance. We're not going to go into the specifics, but let's just suffice it here to say it has to be the right type from the right kind of company. This is my opinion. I know that I've seen many different variations of advisors trying to say that they can do this infinite banking concept with different types of life insurance. I personally believe that that's not correct. There's only one really the best type that I personally believe, and the right design of that particular kind of policy. But let's just say that we have a life insurance cash value. The insurance company allows us to use our cash value as collateral. They will lend us money based on the amount of money we have in cash value, and then allow us to continue earning a rate of return on that cash value while we have a loan from the insurance company. And when we pay it back, we're paying back the insurance company, not us. It's not our money, because we did not, remember, you did not borrow your own money. You borrowed from a financial institution. In the third way, it was just happened to be a life insurance company. So we can get it from Aunt Gladys, we can get it from an investment company, or we can get it from a life insurance company. But what is the real reason that it works, this bank on yourself concept? And I'm going to just give you a quick rundown of really the concept that I think and the principle, if you will, that I think is the magic behind the bank on yourself and using properly deployed debt for an investment. It's concept called compound interest versus amortized interest. And all things being equal, compound interest will always beat out amortized interest. So I'm going to have this in the show notes, but I'll run through an example. So let's say we have a compounding account. So this is an account that we have $100,000 in, and it's going to earn 5% for 10 years. Nice, easy math. 5% for 10 years, okay? And when we go through that, it's going to be, let's take and do the math real quick. Okay, I'm going to back up here. I just realized as I was doing this that I had done the math on $50,000 and not on $100,000. So let's do the math on $50,000 at 5% for 10 years. So if we earn 5% on 50 grand for 10 years, we have an account value of $81,445. So we went from $50,000 to $81,445. So that's a $31,445 gain. All right, so got that. $31,445 gain. Okay, now, what if we took out a loan from an investment company, Aunt Gladys, or a life insurance company for $50,000 at 5% interest, the loan interest at 5% interest for 10 years? Let's run the math on that and let's pay that loan back. Now, so here's what it looks like. A $50,000 loan at 5% for 10 years is $530 a month. $530 a month for 10 years is total payments of $63,639. $63,639 minus $50,000 is a total interest cost of $13,639. Okay, so remember, $50,000 compounding at 5% for 10 years, we grew up $31,000 extra. A loan at 5% over 10 years cost us $13,639. So we had a gain of 31, and we actually had a cost of 13. So let's do the math. If we actually took the two of them, we take the compounded account, how much do we earn? $31,445. And then we take the loan, the cost, $13,639. We actually have a net gain of $17,806. $17,806. How did we have a loan at 5% and a compounding account at 5%? You see, most people think that that's going to be a net wash. So how do we end up with a gain? How do we end up with a situation where borrowing money and leaving our $50,000 in an account to earn 5%, how do we end up with a $17,000 net gain? Well, here's the principle, if you will, in a nutshell. Compounding interest is compounding on an increasingly larger amount of money. So you get compound interest on the principal, you get interest on the interest, you get interest on everything. It just grows and grows and grows. So compounding interest is on an increasingly larger amount of money. On a loan, an amortized account, you are paying interest on a smaller and smaller amount of money over the period of that same time frame. So compound interest will always beat amortized interest, all things being equal. Now, this is why it's so important that the money used has to be deployed correctly. And I use that word it's a very militaristic type of word, deployment. really deploying the money correctly. And that's where I have a real bone to pick with the infinite banking, bank on yourself community sometimes, is that they talk about using this loan for buying groceries and basic everyday this and that. And that, I think that is just irresponsible personally. That this is one of the greatest concepts that any investor, any person can really understand, compound versus amortized. I think it needs to be respected and really used and deployed correctly. And when you do it that way, it's a very powerful concept. I mean, this is how, for example, real estate returns can be dramatically magnified when you use properly structured debt to acquire real estate, a compounding, growing asset, right? Using a loan with reducing smaller and smaller interest payments. That's why they work so well together. So there's a lot of numbers in there. Check the show notes. If you have questions about this infinite banking or bank on yourself concept, full disclosure, I'm a big fan. I really do believe in the concept, and I use it personally. Just so that you know, I do use it personally, and yet I also hear stories of the sales pitch gone wrong. I just don't agree with the way that many people out there are attempting to design these and to sell this. It really needs to be done right, with the right company, with the right design. If you have questions, go to personalpensionradio.com and ask. Don't jump into an infinite banking or a bank on yourself concept or relationship with someone without getting in touch with me, and at least give yourself that little edge. Ask some questions, okay? So let me jump into this, the next segment here, and this was one that I hear this all the time, and this came from a recent interaction with someone in my office, and it is, am I diversified? Am I diversified? And my answer most of the time is probably not. Okay, so to be a bit wonky, I'm going to go to the most reliable source for definitions on the planet. You know it, Wikipedia, right? I'm going to go to Wikipedia, and I just was curious, what does diversification mean? Well, here's what it says. In finance, diversification is the process of allocating capital in a way that reduces the exposure to any one particular asset or risk. A common path towards diversification is to reduce risk or volatility by investing in a variety of assets. All right, that makes sense, right? That sounds good. So here's what I hear all the time, and one of my favorite people, he's always better than he deserves, and he's the number one financial entertainer on the planet today. He says that you should have a diversified investment portfolio. And he uses that word all the time. Diversified investment portfolio that has growth stocks, mutual funds is what he says. Growth stock mutual funds, international mutual funds, small caps, large caps, etc., etc. So he says growth, small cap, mid cap, international funds, bond funds, target date funds, all of these things are mutual funds. So here's what I did today, and I've done this 1,000 times, I swear, in my practice. I get the question, or I ask the question, so tell me about your investment portfolio. Inevitably, they will use some phrasing that either alludes to or includes the word diversified. It's spread out over a variety of investments to reduce risk, or et cetera, okay? Well, this particular person came to visit me recently, and I asked the same kind of questions about the investment portfolio, and I said, so you're in a diversified portfolio? Oh, yes, definitely a diversified portfolio. Well, here's something that you can do to check your own portfolio. It's very easy. You don't need me, but I'd be happy to do it because I go into more depth than most people do, and I'm not going to go into that here in this particular discussion here. But what I did was I actually took Yahoo Finance. I like their stock charts. They have a lot of really good things where you can actually do stocks and mutual funds and you can overlay them on a chart. And so I'm going to include it in the show notes. I actually have a picture of it here so you can see what it looks like. But here's what we did. Together, we went through and we put the Standard & Poor's 500 chart on the screen for the last 5 years. So the last 5 years, you see this line going up and down, generally up. It's been very volatile, but up and down, but generally up and to the right. And then we overlaid 1, 2, 3, 4, 5, 6 more of these mutual funds in his investment portfolio. Okay? It's an oxymoron to have 6 different mutual funds inside a portfolio and then the advisor claims that you're diversified. Because mutual funds, in my opinion, by themselves are gigantic baskets of diversified investments. And when you look at these multi-million-dollar and billion-dollar mutual funds, it's inevitable that they're going to have overlaps and crossovers with each other because they're so big, right? A mutual fund by itself is diversified in its own way. But here's what happened. We overlaid an international fund, a growth fund, a small cap, a mid cap. We overlaid a target date fund. We overlaid all of these things. And lo and behold, every single one of them moved up and down as the Standard & Poor's 500 moved up and down. You can see virtually identical movement in each of the other mutual fund options. So if diversification is supposed to reduce exposure to any one particular asset or risk, well, how does that make sense then if all of these mutual funds basically move identically in identical patterns to the market index? They're clearly not diversified then, are they? They're not diversified. Now, he had one option in his portfolio that moved in the opposite direction of his investment of the market. He had a bond mutual fund, and that bond mutual fund has not done well. So the Standard & Poor's and the other ones actually generally went up and to the right. His bond mutual fund went basically flat and down to the right. It just hasn't done well. So I guess that would count as being diversified because it moved in the opposite direction. It's not really ideal. But diversification, truly diversified portfolios, we really want to seek out investments that do not move with each other. They don't move in the exact mirror image. And if you look at your 401k or your investment account statement and you take those to Yahoo Finance, grab a chart, it's free, and just start overlaying them over the Standard & Poor's 500, think you'll be surprised. You find out that you're not as diversified as you thought because this idea that getting a growth, international, small cap, mid cap, that magically makes you diversified, that's not right. It's actually completely wrong. That true diversification takes a heck of a lot more than just throwing 5 different mutual funds in your portfolio. So if you haven't done that, or if you have questions about are you diversified, please go to Personal Pension Radio, give me a call, give me an email, and I would be happy to review and discuss your investment portfolio with you to help you understand some of the things that you might not be aware of inside your portfolio. Because I've said it on the podcast before, if, for example, in this gentleman's portfolio, if we have 5, 6 different mutual funds, all basically moving in the same direction, what's the most important thing to go after then? Go after the least expensive option. Because I'll tell you what, the international option costs way more than the basic growth option. And the small cap costs more than the basic growth option. So if they're all moving in the same direction, why not go after the least expensive investment option that you're getting the same movement up and down anyway? Why not save money while you're doing it? I mean, that's just my opinion, as far as I look at diversification. But please, when you ask the question diversified and some financial advisor says, well, we're going to put 5 or 6 different mutual funds in your account, well, that is not the answer to diversification. Have them overlay those investments against the market index, Standard & Poor's. Run it over a 5-year period, and you take a look at that. And if they all move up and down together, that's not diversified. That's lockstep. Okay? I want to finish with a couple of fun things here. Just really good things, good connections, some client stories. So I have a gentleman, let's call him the milkman and his wife, okay? That when we met, he had a variable annuity. And I call this guy variable annuity clueless. So if you don't know what a variable annuity is, it is a type of an annuity from an insurance company that has investment risk subcategories and asset inside of it. And I've made full disclosure out there, and everybody knows, I think, publicly that I generally am not a big fan of variable annuities, but I'll say this. There's a reason for variable annuity, and there are some benefits that I personally think that shouldn't be overlooked with variable annuities. But my big beef with variable annuities is most of the time is the fees. Variable annuities are pretty expensive. In many situations, people don't understand just how expensive they can be. That these annuities, variable annuities, are often sold with the idea that there is a life insurance benefit, there's an income benefit, there's a this benefit and a that benefit. Well, every time you hear a benefit like a death benefit or an income benefit, that includes a commensurate fee that goes with it. Variable annuities can be expensive. So this gentleman that I met, that I've known for a long time, he's been a client for a long time, he's had a variable annuity for a long time. And when we first met several years ago, my advice, due to the hefty penalties associated with the annuity, was to just stick it out and hang on to it, and we worked on reducing the fees and costs inside the account as much as we could, and then we get to the point where it's time to look at what he really wanted from the annuity. And what he really wanted from the annuity, right, and we talked about this at the beginning of the show, I mentioned it, why do we save money? We save money for retirement so we can have retirement income someday. Well, that's what he wants. He wants retirement income. So the big question, right, as we got to a point now with this annuity was, should we keep it, right? Him and his wife, should they keep it and use that to draw income from, or should they search out an alternate income method? So when we went in there and started doing the research on this annuity, I knew that there were expenses in there, but my goodness, it was just another reminder that variable annuities over a long period of time can be substantially expensive. I mean, really, it was pretty extreme. But the big wake-up call, this is where I say variable annuity clueless for this gentleman, was the income options. The income options were actually really disappointing to him and his wife. So as you look at someone who might be suggesting a variable annuity or a standard annuity or a mutual fund or whatever that's being recommended, ask the big question, what's the income strategy for this account? How much can I plan to draw from when I'm 70, when I'm 65? How much can I draw from this account when I'm retired? That's the question you should be asking if you're doing a retirement savings account, whatever it is, whether it's a variable annuity or not. So just the happy side of the variable annuity story is that we were able to put side by side his options as it relates to his variable annuity income options and alternate income options. And one side had substantial benefits. The other side did have some guarantees built into that variable annuity contract, but the expense and the cost of getting there and some of the risks associated with it were going to be just too significant. And it was an option where a simple, boring, guaranteed account is going to have a better income options for him and his wife. So if you're out there wondering about variable annuities, or if you have a variable annuity and you wonder whether or not you're variable annuity clueless, go to Personal Pension Radio. Get in touch with me. Let's talk. I have no qualms about sitting down and saying, yep, you should keep that variable annuity and maybe you should look at this and look at that. But if you've never had a conversation with someone like myself who has my particular opinion set on variable annuities, you might want to do that if you've had that kind of proposal, or if you already have one. Give me a call. This is actually going to turn out very nicely for the milkman and his wife, but wanted to make sure that I shared that with you. And then finally, a really cool story about a corporate sales VP, retired from a big company. His wife has been just a wonderful support to him at home with their 2 boys, raising up some good kids, and they got to retirement, and he hit his retirement in 2012. So in 2012, the stock market and the investment world were basically recovering from a really ugly time, but on the upswing. And he started taking his income distributions at a nice period of time in the investment world as the world was going up. Now, when I sat down with him, I was introduced by another one of his advisors who suggested that you might want to talk to the income engineer, Kraig Strom, and just go over your income strategy. So as we sat down and we went through this, I could sense right away that he was very prideful in his investment account portfolio, very prideful. And he's taken this much money out of his account over the last few years, and the account has done just fine, and everything was good. And I asked him if he had a particular plan for sequence risk. When the market goes down, what is the plan to draw income and to give the account a break so that they don't deplete principal too severely? He said, very confidently again, very proud of his investment accounts, that, oh, I'm fine, everything's good, we've got that covered. And he said the magic word. He said, we're diversified. Well, as it turns out, just as I mentioned before, he wasn't diversified at all. We went through and overlaid everything, and all of those mutual funds in his investment portfolio, they were all moving lockstep with the basic market index. It was not a diversified portfolio. It was actually just lockstep with the market. But during the conversation, here's the thing. I say that his wife saved him because she said, hey, you know what, honey, we were talking the other day, we both agreed we were kind of nervous about the next year or two, because we were both saying that the market could probably correct, and what are we going to do then? She jumped in and said what he didn't want to say. He was a good guy and said, yeah, you're right. And he told his wife, you're right. And they ultimately did decide to move their investments to work with me, and they happened to move at the right time. So there was no magic in this. I don't want you to think that I had anything to do with, like, I'm some investment guru, because I am not. I just believe in good, sound principles, but I have to give this gentleman's wife full credit, because if it hadn't have been for her kind of pushing him and poking him with a stick, he probably would have been still just all proud of his investments and staying where he was. But he did decide to move. And in the process of transferring his investments, he was out of the stock market as the stock market took a huge correction, a big correction. He had a large amount of his account assets out of the investment world at just the right time as the market fell, and then back into the market at the right time. So thanks to his wife for speaking up and saying, hey, we're nervous about that, honey, don't you remember? and good on him for actually admitting that his wife was right. Okay, so and again, no magic there. He just happened to move at just the right time. But it goes back to that diversification thing. You think you're diversified? Probably not. Get in touch with me. Let's find out. Let's talk. that'll wrap it up for today. Make sure that you go to iTunes, leave us a review in there. I'm not allowed to ask for any kind of special treatment on the reviews. Just leave us whatever you'd like to leave us. Trust me, I can't ask or beg for reviews on iTunes. You just have to go there at your own volition. But listen, keep those questions coming to personalpensionradio.com. Keep asking questions. Tell us what you want to hear. Tell me what you want to hear on the show. And I'll do my best to include it in the upcoming episodes. Have a great one. Take care. And remember, ask questions. Don't follow conventional wisdom blindly. Don't just get in line. Step out of line. Share this podcast with your friends and ask questions. I'll be happy to talk. Talk to you soon.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we'd appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.